Welcome to Module 4. In this module, we'll be focusing on market timing, private equity and share options. So far in the Masterclass, you've learned about why you should invest, gained an understanding of risk and asset classes, learned a lot about stocks, bonds and how to put a portfolio together. But you might still be a little bit nervous when it comes to market timing. At the end of 2022, many market analysts predicted a recession in 2023. And while inflation dominated, the anticipated recession never appeared. When you're a new investor, any whisper of a global slowdown might make you think twice before trying to build your capital in stocks and bonds. Recession fears bring the topic of market timing into focus. The definition of market timing is the act of moving investment money in or out of financial markets or switching funds between asset classes based on predictive methods. Simply put, if investors can predict when the market will go up or down, they can in theory make trades that can turn a profit. In Module 2, you learned about active investing and passive investing. Passive investing is best described as a buy and hold approach to an asset with a long-term capital appreciation goal in mind. Active investing, however, is the central process of market timing. Market timing is a challenge for the average investor and is more suited to short-term investments by professional day traders, portfolio managers and other financial professionals. The advantages to market timing are bigger profits, curtailed losses and avoidance of volatility. But it does require a lot of research and daily attention to markets. There are also frequent transaction costs and tax on capital gains. Timing your buy into a stock and selling off a stock at the perfect time is very difficult. So where does this leave us? Market timing is not always on our side and recession fears make us reluctant investors. It's impossible to know exactly what will happen in the longer term, but according to what we do know from the past, not investing at all or taking your money out of the market during a recession would be a strategic mistake. As you learned from Module 1, the global stock market has increased its value by 7 to 10% every year, even during years of financial turmoil, including 2008. Here's the good news. Investing during a recession does not mean lower returns over the longer term. In fact, an investor who begins their journey during a volatile moment will see returns comparable to that of any other over the next few years. The decisive factor for returns is the longevity of the investment, not the time at which it's first made. As we always say to both our new and experienced clients, time in the market is what matters, not timing. Look at the data here from the US National Bureau of Economic Research. It shows us that even if you begin investing into the S&P 500 at the beginning of a recession, you will still see a return of 22% in 5 years. As you know, cash kept in a deposit account will lose its worth dramatically due to inflation and decline in value by roughly 10 to 15%. The data also shows us that while investments made 6 months before a slowdown lose value when the recession hits, the return in 5 years is still significant at approximately 24.7%. In 10 years, it grows to around 136%. Investors are always trying to gauge the point when the market is lowest, but this point can only ever be known in hindsight. To obtain the best possible return, the best move is to spread your entry points, thus diversifying the market timing. So keep in mind that good returns can still be made even at a time of uncertainty. On only 5 occasions since 1930 has the S&P declined more than 15% in the first 6 months of a calendar year. During those periods, the median decline was 20% and the median performance in the second half of the year was plus 15%. Whether a recession is imminent or not, the return is still possible in the short term. During the COVID-19 recession, market commentary swung between predictions of global depression to V-shaped recovery boom scenarios. No one knew the answer, nor would most have predicted that markets would have survived as well as they did. This is why it's important to build a portfolio that's in line with your risk profile and it can withstand and travel through an uncertain environment. I'll be back in part 2 to tell you more about private equity. See you then.